commercial real estate. That's got a double whammy because not only have you got rising interest rates, but you've got collapsing occupancy. What does the Fed do? Does it sort of suppress interest rates to stop all these businesses going bust? It probably has no option. But then you've got to ask yourself, what does that do to the dollar? It's going to tank, isn't it? Against what? Against all the other currencies which have got exactly the same problem to greater or lesser degrees and in maybe slightly different detail.
Hello and welcome to the show. As always, I'm your host, Alex Daly. Today, we're speaking with Alasdair Macleod, one of the more interesting voices in finance. Through his Substack, Alasdair spends a lot of time educating people on the history of monetary policy, fiscal policy, what it's meant for people's purchasing power, what it's meant for equities markets, bond markets. And he takes that historical perspective and applies it to what he's seeing today in things like rising government debt, rising bond yields, and the decisions faced by the Federal Reserve and other central banks. We're going to dive into his macroeconomic viewpoint and try to understand what he sees ahead for the markets right now. Before we do, just a quick reminder that nothing in this video constitutes personalized investment advice. We make these videos for educational purposes only. Also, if you enjoy this video, just hit that like button, let the algorithm know that you want to see more from us when we publish. With all that said, Alasdair, welcome to the show.
My pleasure. Thank you for having me, Alex.
Now, Alasdair, you have long said that we are in the midst of a credit bubble, I believe you've called it, bigger than 2008 or really any credit bubble in history. Can you explain a little bit of what you mean by that and where you believe we are in this bubble cycle?
Yes, sure. I mean, credit bubble is something which periodically happens throughout history. And it's basically when credit, you just end up with too much credit in the system and it needs to be washed out. It's actually quite hard to recognize at the time because, you may be in good times and you think this is absolutely fine and everything's going all right. Okay, the economy isn't great, but, stocks are going up and so on. That's classic credit bubble, but very difficult to recognize when you're in it. It's far easier to recognize the debt side of credit. And I think we can all agree that we are in a debt bubble. And indeed, we're in the largest debt bubble. For every debt, there is a credit. And of course, it depends where that credit is targeted. And the credit is targeted very, very much at financial assets and particularly equities. So that's the background to it. Previous examples of these credit bubbles, I mean, we could go back into history for, so long as we've got, sort of good financial records. You've got the Mississippi bubble in France, which was engineered by John Law, who basically was a proto-Keynesian. You had the South Sea bubble in London. You had the tulip bubble before these two. And that actually was based on a commodity, if you like. Not much of a commodity. I think someone actually ate an onion thinking it was an onion and it turned out to be a very valuable tulip bulb. But anyway, so that's the sort of thing that goes on. When you get this credit being produced and it goes into financial assets, that is your classic credit bubble. The last really big one, of course, was 1929, following the Roaring Twenties. We've all heard the stories of the Roaring Twenties and how, bellhops were giving tips to people and also shoe shine boys and so on were telling the next customer, the previous guy who's, Mr. So-and-so and so-and-so of such and such a bank is buying this and, passing tips, all that sort of environment. We saw that actually with the dot-com bubble back in the year 2000. So those are examples, if you like, of bubbles. This credit bubble is, by any measure, the largest in history. Again, I say, if you doubt that, just look at the debt. The debt is the largest in history. All major governments are, G7 governments, with the exception of Germany, but they're going there, are like 100% debt to GDP or even more. In the US, it's 120% or something. UK, it's a bit over 100. France is about 110, 115. Germany is about sort of 65, but, they've just taken the brakes off debt limitations to spend money on defense, allegedly. But the economy is tanking. So this is the other problem with debt to GDP numbers. When the economy tanks, obviously, the number just shoots up because the divisor, is getting smaller. So that basically is where we are. Now, there are concerns, I think, about this position. We look very similar to 1929 in two respects. First of all, this is a purely financial bubble concentrated on markets. And the second thing is that in 1930, we had the Smoot-Hawley Tariff Act. Today, we've got a far bigger bubble than we had in 1929. And we have, call it Smoot-Hawley Mark II. I mean, we don't know how Trump's tariffs are going to settle down, but there is widespread ignorance, even in the economic community, about the consequences of tariffs. But the evidence from the Smoot-Hawley Tariff Act is absolutely clear. It just absolutely backfires every way you can imagine on the perpetrator of higher tariffs. I mean, we start off with, some tariffs, some trade restrictions and all the rest of it. And that is now increasing. So I would think that the way Trump's tariffs will settle out are probably going to be at least as bad as the Smoot-Hawley tariffs in 1930, which it's estimated added another 20-odd%, if you like, on the value of imported products. And of course, it's not just imported products for consumers, it's also intermediate goods which are affected. And in many cases, commodities as well. And we're seeing exactly the same thing today. So those two things basically happened at the peak of 1929. We are very close to the peak of this one. I mean, I wouldn't be surprised if it's a very unhappy anniversary, a downturn, if you like, the market peaking within the next month or two. I think your next question should be, what's going to trigger it? That, quite clearly, is bond yields. I mean, there is this misconception that central banks actually have complete control over interest rates and bond yields. They can start with interest rates and then they can do yield curve manipulation, whatever. No. They can do that a lot of the time in ordinary times. But when you get an extreme time like this, they've got no control. Just look at the long bond yields in the US T-bills. Look at the long gilt. Look at the long JGB. I'm talking 30-year maturities here. And also, this will surprise you, look at Germany's 30-year bond. All these yields are either going into new high ground, which means that the markets are tanking, or look as if they're on the verge of going into new high ground. You find, I mean, I've been a broker for, 6 decades or something. And the one thing I have noticed, the relationship between bond yields and equity markets is that the equity market will always stand the initial rise in bond yields. But when you get a second rise in bond yields, that valuation effect works through negatively to the equity markets, and you then get a bear market in equities. We've had the initial rise, which was actually quite nasty, like from zero effectively and negative in some cases, up to where we are now, yielding, looking at US treasuries, 4.2% on the 10-year. Looking at Germany, we're looking at about 3.6 or something on the 30-year bond. In the UK, we're looking at 4.7 on the 10-year. I mean, this was quite a sharp move up, basically. And so far, I mean, there was a bit of a wobble when this really sort of got kind of rich in the equity market. But then as yields backed off, consolidating, moving sideways broadly, the equity market has just roared. And so what's been pushing it? I mean, this business about a credit bubble, just look at the FINRA numbers for margin debt. That is now over $1 trillion. And bearing in mind that back in 2010, it was about 200 billion. It's now over $1 trillion. That is real leverage in the wrong place. This is what I mean about a credit bubble really hitting financial assets.
You said something in there. I just want to make sure I understand. And you said that this is a credit bubble targeted almost entirely at financial assets. Can you help us understand how that differs from previous credit bubbles? You mentioned things like the South Sea bubble, which famously, my favorite anecdote is that the South Sea bubble ruined Sir Isaac Newton. He put pretty much all of his money into it near the high and lost the majority of it. So if the smartest man in the world who invented calculus can get caught up in a bubble and not recognize it when he's in it, shows that all of us can.
Well, let me just say the smartest people in the economic world don't understand credit, which is why they get sucked in at the top, as Keynes did in 1929, as Fisher did in 1929. I think I can't remember who it was. I think it was it. I think it was Fisher who said something like, equities are never going to go down or something. Well, all these bubbles are fueled by credit. I mean, if you go back to the South Sea bubble, for example, now in those days we think that everything was settled in gold or paper which represented gold, like in the form of a banknote which was actually backed by gold. But no, actually what was happening was that the goldsmiths were the sort of proto-banking system which we have today. And they were creating credit just the same as the way banks do today. They were lending it into existence. And of course, you got people turning up wanting to invest in the South Sea stocks and things like that. So, this guy's creditworthy. Yeah, okay, we'll create some credit for him. So that's what happened. You get the credit bubble. They're all credit bubbles. I think we should understand that credit is actually a good thing as long as it's not misapplied. There are three ways in which you can apply it. One is you can apply it to finance production. That is good, and it's not inflationary. Or you can apply it to finance consumption. That is inflationary, and it's not good. Or the third way you do it is you apply it to financial assets, and that just merely inflates the financial assets. It spreads a good feel-good factor, and the collateral which you've got against the loans goes up and up and up. So banks are happy with this, and they think this is absolutely wonderful, but they don't actually realize what they're doing is creating a bubble, which at some stage is going to burst, and then everything goes into reverse. So that's what I mean by the application of credit. I mean, there are those three ways in which it happens, and with a financial bubble, it's angled mainly at financial assets.
So you're saying all this margin debt, this $1 trillion, people are borrowing it into existence and then buying stocks, causing stocks to go up. So everybody feels good, but we're all the more leveraged. I think we remember how margin debt ended in 2008, right?
We didn't have anything like this level of margin debt. I mean, the difference then was that credit was being applied into residential property. It wasn't really being applied into financial assets as such. It was applied into the financing of residential property. And of course, we had not just, the inflation, if you like, of property prices, but we had bad practices, getting on the back of this, all this sort of leverage, with sort of artificial synthetic means of financing and all this sort of stuff. And it was that went wrong. And of course, the other thing is that derivatives as a whole had increased quite a lot on the back of this. And there were misunderstandings about what derivatives were. We had AID, insurance company, originator of many derivatives, because they looked at derivatives as an extension of the insurance business, which you could argue it is. But it's actually a completely different animal. When things went wrong, they went wrong big time. And so that was effectively a problem over property and derivatives. This time is different. Property is not really, property has increased in value along with, if you like, the falling purchasing power of the currencies. But it hasn't been all that spectacular, generally. Obviously there are areas where it has been spectacular. But today, really, this credit has been very much targeted at equities, and particularly the sort of equities which you saw in the dot-com bubble, high tech, new stuff, AI, and so on. Things we don't understand, but we're buying the damn things because they're going up. Anyone who's old-fashioned enough to think that value matters, go away, you're an idiot. They're all pursuing momentum. And what happens with momentum when it goes? Oh dear, we remember that. Do you remember the NASDAQ falling after the year 2000? I think it lost 3/4 of its value.
I remember it quite well. So let's talk about that unwinding. You mentioned that bond yields might be the trigger, the pin that pricks the bubble. What would cause bond yields to go further up? Like what is going to trigger that sell-off in bonds to get us there?
Well, this is where people have got to understand what an interest rate is. If this is interest rates are a reflection of risk. It's as simple as that. And also, at a very, very minor level in these fiat currency days, it's also the fact that you're using my money, or my facilities, my credit, whatever. I'm handing it over to you. Now, I'm not going to do that for nothing. So, there is a sort of an element of that in it. But the main thing really nowadays is risk. And you've got two risks. The obvious one, if you lend credit to, say, a corporation or something like that, you've got the risk that they won't repay. Similarly, if you lend money to a bank in the form of a deposit, there is the risk that they may not repay. Now, in normal times, it's a very small risk. But nevertheless, you should expect a small premium over the value, if you like, to you of actually just parting with the credit as opposed to the risk within the credit. But then today there is another risk, and that is the currency risk. The currency risk is big because the issuers of these currencies are getting into huge debt, and there is absolutely no sign that they're taking the foot off that accelerator. It's getting faster, and particularly with the dollar. So what we're seeing is the risk element, if you like, as far as buyers of bonds, in other words, lenders of credit to the US government are concerned, the risk element is getting higher and higher. Now, part of that is reflected in the fall in the purchasing power of the dollar, which we translate into inflation. We see prices rising. And if you're going to go and buy, say, a T-bill or something like that, which is going to be redeemed within the next 28 days or half year or whatever, then, that's actually not too much of a problem. You're not going to lose too much, if you like, if there's a sort of, if prices start rising, whatever. But if you're going to go and buy something which is, say, 10, 15, 20 years out, then, what's the return? How do you measure this risk? Well, the answer basically is that you've got to sort of think, what's going to happen to the purchasing power of the dollar over that sort of time? And all right, you might put it into a computer if you've got a very clever program, but basically you think, this is risk. What's got to be my reward? And then you look at the possibility of a debt trap. Now, how does that arise? Well, the way in which interest is paid, not that it's ever paid, but it's accounted for, is out of taxation, okay? So you're looking at the private sector's ability to produce the revenue for the government to cover the interest on the debt. Now, the private sector in America and everywhere else is not growing. You look at GDP, it's growing, yeah, but take out the government deficit, then you've got a better idea of actually what's being produced by the private sector. The private sector, if you take that deficit out, is actually contracting and has been for the last 2 years, and will probably contract even more in the future. So the ability of the US government to service its long-term debt is being badly compromised. So what's my risk? What's my risk in this as a potential buyer? It's increasing. I can't quantify it. I don't want to buy this stuff. So what happens is that the bond have to fall in the market. In other words, the yield has to rise to a point where I may be tempted to do this. But the problem with the debt trap is the higher the yield goes, the worse the position is. So, if you're not going to buy it yielding, 5%, I think it's 4.9% or something on the 30-year, the long bond. If you're not going to buy it at that, you're not going to buy it at 6% or 10%. What's going to make you buy it? Well, there's got to be, yields are going to have to rise to the point where the politicians actually notice and think, we've got to do something about this. We've got to cut our spending. Now, how far away are we from that? I think we're an awful long way away. So you can see that there is significant upside in the yields on the long end of the bond market. And that will definitely crash the equity market.
Am I reading you right that you're saying this could be sort of a slow motion unwind, that we're not going to see, sort of this sudden spike in yields to 7%, 8%, 10%, as you said, in the next few months, probably? But the U.S. government's going to continue to be able to borrow. Other governments are going to continue to be able to borrow before people start selling in mass. Did I understand that correctly?
I think the two considerations in this one. The first is that I think we're likely to see bond yields go up quite sharply in the near term. And it could be when everybody gets back on holiday and looks at the numbers and sort of thinks, oh, my God, this is not good. We've got to sell bonds, or we've got to, whatever. I mean, that could be next month, happy anniversary 1929. It could well be. But the problem is that bond yields are going to continue rising afterwards. That's the real trouble. And then the Fed has got a huge issue because at the moment we're all expecting the Fed to cut interest rates once in September, which if this doesn't happen before then, we will get, I'm sure, because it's become so political that, it's not going to happen otherwise. But after that, we still expect further cuts in interest rates. At least the market seems to be discounting this on every measure that I read about. Markets got it horribly wrong. And this is going to be a very nasty wake-up shock. It really is. I mean, and what does the Fed do? I mean, the problem is that as bond yields start rising again, you're going to have banks getting into difficulties, but probably more than that, businesses in the private sector getting into difficulties. I mean, and we're talking about, not just big corporations. We're also talking about all the zombies who, for years, decades, have enjoyed the privilege of borrowing at suppressed rates, suppressed because the Fed has suppressed the rates. And so they've taken on debt, which is effectively unproductive. And they've got to refinance it. I mean, we got a classic one in this country, in the UK, Thames Water. I mean, it's a model, actually, because Thames Water is a utility. And God bless Thames Water, they have got a regulator who will say, you've got to invest this much, you've got to do this, you've got to do that. And it's going to leave your shareholders with a net return of 8%. Now, come hell or high water, you're going to get that 8%. So what happens? The private equity vultures come along and they buy this and they leverage it up 4 or 5 times with very low interest rates. So they're creaming something like between 30 and 40% out of this utility, but now it's got to be refinanced. And guess what? They can't refinance it. And I think that's just the start of what's happening, and it'll happen everywhere. I mean, I'm sure that, obviously I'm not close to US corporations, but I'm sure that if you look at throughout the US economy, you'll find lots and lots of cases like this. I mean, a very good example, for example, to just quote one off the top of my head, is commercial real estate. That's got a double whammy because not only have you got rising interest rates, but you've got collapsing occupancy. So everybody's working from home or whatever, so the whole, what does the Fed do? Does it sort of suppress interest rates to stop all these businesses going bust? It probably has no option. But then you've got to ask yourself, what does that do to the dollar? It's going to tank, isn't it? Against what? Against all the other currencies which got exactly the same problem to greater or lesser degrees and in maybe slightly different detail.
Yeah, that's exactly the question I was going to ask, right? Like you can't, where does this money go, right? Like you can't just say like, oh, everybody's going to sell dollars and buy, Brazilian reals or even euros. Even we're not all going to go out and start like buying a basket of yuan, are we?
Okay, well, this is something which I think people have got to understand. It will go somewhere on the margin, yeah? And it's that going on the margin that undermines values. So actually what's happening is that credit and debt goes into thin air. In other words, it just loses its value, both sides at the same time. And what does that mean? That means that your government bonds go down and down and down and down. And if you're unfortunate enough to own any, your assets go down and down and down and down. So both debt and credit collapse in synchronization. As far as banks are concerned, the only time that credit actually gets destroyed as opposed to losing its value in the market, is through bad debts. And then they've got to either take it on the chin, in which case it wipes out their capital, or their creditors, the bank's creditors, take it on the chin. So this is something which people find quite hard to understand. Collapsing equity prices are exactly the same thing. I mean, people think that equities aren't credit. Yes, they are. Because when you buy a share in a company, you're buying a promise from the management to deliver a stream of dividends or value to you as a shareholder. But it's actually worse than that because you've now got an intermediary in between you and the company because you're not taking certificates anymore. There's a chain of promises. The company promises, say, is it the DTC or Euroclear, which holds all the shares in a register, as it were. And then the DTC or the Euroclear then have a promise to you. You don't own anything. You've just got you're at the end of a chain of promises. And this is a situation which, I mean, I can see why it's come about. It's come about simply because, these holders, if you like, of shares in an uncertificated environment have no capital of their own. And when things start going wrong, and you get counterparty failures all over the place, they would go bust as well. I mean, think Comex, they would go bust. So what happens? Well, the answer is that they will take your shares and offer it as collateral against people who had been on the wrong end of a failed to deliver it.
That's the rehypothecation problem that I think a couple of people have raised about this market, right? Where they take your assets and hypothecate them as collateral for someone else's debt. And that's the whole unwinding of this margin you're talking about, right? This $1 trillion in margin debt borrowing is effectively, that's what they would be backstopping with potentially communal assets. It's a theory. I don't think we've seen that happen yet in the markets, have we? Has there ever been like an incident where this has occurred?
Alex, you're absolutely right. I mean, the reason we haven't seen it is the Fed has very successfully, the Fed and the US Treasury has very, very successfully managed the crises in the past. And their intervention has, if you like, kicked the can down the road. I mean, whether it's intervening by, as they did in 2008, or whether it was the way in which Greenspan intervened back in 2001, they're just cutting interest rates down to 1%. I think he got it down to. That sort of intervention basically sort of supported the system. What I'm arguing is that they don't have that degree of control anymore. They've effectively lost control. And that's frightening. I mean, it really is frightening. What we're looking at, Alex, is the end of the fiat currency age era, which started back in 71. And that is going to be horrible. I mean, it really is. I can't see there is any way out of it without governments changing their responsibilities to the markets, in the sense that they've got to understand that they've got to stop spending more than they receive in taxes. They've got to understand that they've got to reduce their involvement in the economy and cut back on welfare and all, everything. I mean, do what Doge did, but, like big time. I mean, we're talking about doing at least what Milei is doing in Argentina and more. So until you see that, we haven't got a hope. The currencies go. And of course, the only way this actually works out at the end of the day is you've got to fix the value of credit to real money, which in everyone's common law, despite what the US Treasury says, is not a pet rock, it's gold. Gold is, in common law, everybody's final settlement. And the point about credit is it's never final settlement. You're always passing, it's passing bucks around, if you like, from pillar to post, etc. It's not final settlement. So you don't need final settlement, so long as you can guarantee the value of credit. That's really, at the end of the day, that's the solution. And how do we move the establishment away from macroeconomic beliefs, Keynesian, monetarist, and so on, into an understanding actually what the difference between money and credit is, the difference between good and bad credit, and to foster an environment where the value of that credit actually is stable. We're in a world of interventionists. That's got to go. That's got to change.
Well, it sounds like you're saying we're going to have to change that the Fed can't intervene anymore, sort of, if you will, fired all of its bullets and is painted into a corner where they can't really lower rates. They can't really raise rates right now. Because of economic weakness. How does this play out for sort of the typical retail investor? Are we just all along for the ride and the powers that be are going to do what they do? And at some point this unwinds, we're in it, you're calling it, it's a bubble and it pops and I just have to suffer that? Or, is there a way that as a retail investor, I should be thinking about how this plays out?
Well, the answer is you've got to understand what we're talking about. That's the first thing. When you understand that, you can make a judgment as to how much you should get out of credit and get into real money. And that basically is the big question for everybody. Because if the currencies are going to hell in a handcart, you can forget equities, you can forget bonds, you can forget even property, because property is financed on the margin by debt, mortgages. And not only that, but as the purchasing power of the currency goes down, the cost of property maintenance exceeds the value of the property. I mean, this is the experience of all previous hyperinflations. I think hyperinflation actually is a misnomer. it applies, if you like, to the expansion of the quantity of the currency. But really what we're talking about is the loss of purchasing power of the currency. And when it's a fiat currency, it is purely the faith in that currency which matters. And that faith is it's already evaporating. I mean, when you think that the exchange rate for dollars into gold was $35 for an ounce back in 71, and now we're 3,350 or something. I mean, you've lost nearly 99% of the purchasing power of dollar credit at the highest level compared with that of real money. I mean, the purchasing power of gold sort of just, it varies a bit, obviously. And I can tell you it's been pretty distorted by the dominance of fiat currencies over the last 54 years. But, you go back, I mean, we've got records, we've got Diocletian's edict of maximum prices going back, I think that was about, 302 AD, something like that. And I've looked at those, and there are various things in there which are very similar in terms of value, measured in gold, then to what they are today. There are obviously markets which have changed completely. We don't have slave markets, for example, anymore. And that sort of relationship. But, on average, you can say that over the very, very long term, the purchasing power of gold remains more or less constant. So it's everything else that varies. And so when we look at gold rising from $35 to $3,350 or whatever we are today, really what you're seeing is the dollar going down, not gold going up. And it's true for all the fiat currencies, which after all are loosely related to the dollar. I mean, the dollar goes down, we go down. I mean, we got our own troubles as well in sterling. They got their own troubles in the Eurozone. And my goodness, they've certainly got them in Japan. We're all going down for our own specific reasons, but the root of it is exactly the same reason, and that is budget deficits undermining the purchasing power of the currencies, and to the point where the faith in these currencies, which is the only thing that really supports them at any time, the faith in those currencies is going to continue to take them down, almost whatever governments try and do, unless they tackle the root causes and fix the value of credit in the form of currencies to gold. But they are a long, long way from doing that.
I think you've already answered this question, but I'll ask it just to put it on the nose, because a lot of people have suggested that this rise in gold prices from $2,000 just about 18 months ago to, in the mid 3,000s has been largely fueled by sovereign changes to like reserve currency balances, buying by the BRICS countries, things like that. And that it may just sort of evaporate or it may just sort of hold itself here and not go any further. I think you're suggesting that there's going to be a flight to gold that will continue to push that asset higher.
Yeah, I mean, basically, again, you're looking at gold going up. This is the mistake. Its currency is going down. And what central banks are doing is they recognize this. So they're selling currencies. You think they're buying gold. They're selling currencies. That's actually what they're doing. That's their rebalancing. They're reducing their dependence on fiat currencies. And are they likely to stop? I would say no. I mean, look, the price of gold is immaterial. It really is. It doesn't matter. Whether it's 2,000 or 10,000, it really doesn't matter. What really matters is the destruction of credit at the top of the biggest credit bubble in history. That's what's happening. And it's the end of the fiat currency era because it's just expanded itself into destruction.
Gold is that neutral commodity. It doesn't have that much in the way of industrial demand or use. It sort of lasts forever, infinitely malleable, all the things that people have talked about over the years about gold, why it makes a good store of value. What does that mean for more industrial commodities? Things like oil, copper, all of that. I mean, if the rest of the markets crash, isn't that a negative for oil, for copper?
That's a fascinating story. I actually looked at this one, and what I found was that measured in gold, and indexing a basket of base metals back to 1900, the current relationship between gold and that basket is the basket has lost, measured in gold, 75% of its value. Now, we can explain that in the sense that gold, being money, is anticipating what is going on with as far as the prospects for fiat currencies are concerned. So that would mean that against base metals, gold has a justifiable premium. But the other way of looking at it is that the consequences of inflating dollars and euros and all the rest of it has been to suppress the value of base metals. So we know that over the long term, that gold's purchasing power against any basket is going to be pretty constant. So we can expect to see the underlying drift, if you like, in prices of base metals going up 3 to 4 times. That would be a sensible proposition. So if we have a collapse in the purchasing power of fiat currencies, then that means that we've got a massive bull market in those metals. Now, how can that be justified, if you like, on supply and demand? Because everybody argues it's all supply and demand. Okay, well, we may not have noticed, but 70% of the world's population is aligning itself behind the Asian hegemons. And they have organized themselves in such a way, both Russia and China, that they've got plenty of gold. I understand from my contacts that along with 2 sovereign wealth funds, the Russians have got about 12,000 tons. And of course, they're a major mine producers. They're accumulating more gold, some of which they may be letting into the market, whatever, particularly dealing with China and so on. But they've got more than the United States, and their population is, 125 million or something. So that's one thing to bear in mind. China, I looked at this very, very carefully quite some time ago. China, the Chinese Communist Party, appointed the People's Bank of China the exclusive responsibility for handling the nation's gold and silver purchases and dealings and all the rest of it, gold and silver. Silver is interesting. We can come to that in a moment if you wish. Now, what then happened? From 1983 to 2002, Chinese citizens were not allowed to buy gold. I don't know about silver. I haven't actually looked at that. But they were not allowed to buy gold. It was against the law. Remember that we had a bear market that ran from roughly 1981 through to 2002. And the West divested itself of substantial quantities of bullion. At the same time, there was massive inward investment going into China. The foreign exchange aspects were being handled by the People's Bank. And then from the late 80s through to 2002, there were massive net outflows through exports. Again, the corresponding currency inflows were being handled by the People's Bank of China. Now, not many people remember this, but if you go back to the 70s and 80s, the general view was that you needed to protect your portfolio by having at least 10% of it in gold. I could see that taking all those flows at contemporary prices, that the People's Bank would have accumulated more than 20,000 tons secretly, not on balance sheet, but spread around various accounts. Over the years, contacts who know about these things, who visit China frequently and all the rest of it, have come back with stories that, yes, there are substantial amounts of gold, for example, in the possession of the People's Liberation Army. So this, I think, is certainly the case, that China has accumulated an awful lot of gold before 2002, probably as much as 20,000 tons. In 2002, they set up the Shanghai Gold Exchange and permitted Chinese citizens to buy gold. Not only that, but they advertised on television in the years, I think, around about 2006-07, go out and buy gold, it's good for you, whatever the strapline was. And since then, the Chinese public have taken delivery of some 27,000 tons from Shanghai Gold Exchange withdrawals. And not only that, but there is even more gold which is stored within the Shanghai Gold Exchange's vaults on behalf of private institutions, Chinese ETFs, and also the gold accounts being run, commercial banks on behalf of their customers. So there is substantial gold there. I mean, China has been like Hotel California for gold. So they are in a position to put their own currency onto a gold standard. Russia can do exactly the same. The reason they have not done so far is they know that if they did that, they would collapse the fiat currency system entirely. So this is not a move that they will do except for defensive purposes. to protect their own currencies. So there will come a point in time when they think, we've got to protect our currencies. We will now go on to a gold standard. Now, you will notice that they're already preparing the ground for this. They are expanding the use of the yuan amongst BRICS nations. And the most recent thing, which was really prompted in its timing by President Trump's tariffs against China, they're now starting to open Shanghai Gold Exchange vaults outside China. And you could exchange gold for yuan through these vaults and vice versa. That is the idea. They've said they're opening one in Hong Kong, which is China's international center, if you like. And they've also said that they're opening one in Saudi Arabia, which is their main energy supplier. So there will be others, I'm sure. And you may remember that in the week after Trump came up, with all his boards saying, tariffs here, there, and everywhere, that President Xi, well, he did two things. He started talking very, very closely about trading more with South Korea and also Japan. And the other thing was, he then emphasized the importance of the ASEAN trade agreement, which will be zero tariffs. He very quickly did a tour around some of the major ASEAN nations. Vietnam was one, Thailand was another, I can't remember where, Malaysia was another one, and so on and so forth. Now, I have no doubt that these trading arrangements are becoming very, very live. You've also got a settlement system, the CIPS, the Chinese settlement system, which is now being used a lot. Multi-currencies, and the way that works is completely different from the way we work things. I mean, let us say I want to buy some euros. What I do is I sell sterling, buy dollars, sell dollars, buy euros. It's an expensive and irrelevant use of dollars. I mean, I don't need it. I don't need dollars. Furthermore, everything that I do in dollars all goes back to correspondent banks in New York City. So everybody in New York knows what the hell I'm doing. I mean, I'm saying this, if you like, in the sort of biggest sense, if you like. I don't want them, if I was Chinese, I wouldn't want them to know what the hell I'm doing with my trade settlements, whatever. But with CIPS, it's very, very easy. I mean, they talk about trading in your own currencies. It's not quite like that, because what they're talking about is you will just deal direct from your currency into Chinese yuan. It's just cutting out the dollar completely. So you can see how this is going to work. Now, we're already, therefore, in the situation where at the drop of a hat, give it a little time until we get a few more agreements in place, but at the drop of a hat, we already have the way in which the gold-backed yuan will work around the Shanghai Cooperation Organization and BRICS, which incidentally is 70% of the world's population and will be the demand factor for all the base metals and all the rest of it, which are so underpriced in gold. So that, I think, probably gives a clue to your viewers that, you should be getting out of momentum stocks and looking very, very seriously at mining stocks. Go for not just the, the monetary metals, gold, silver, and all the rest of it, but also think about some of those rare earths and, uranium and things like this, all those things which may be in short supply as the majority of the world's population industrializes. I mean, this is a new industrial revolution, which is being planned by China and Russia. Now, of course, whether they succeed or not is something that only time will tell, but that is the plan, quite clearly.
This idea of a sort of defensive gold standard sort of waiting in the wings, this pricing of risk that equities are going to fall, that bonds are going to fall, that yields are going to rise. It all sort of sounds so different than what we're living through today. Like you talked about the pricing of risk and zombie companies and rising rates, but like today, junk bond yields are as narrow of a spread to the risk-free return, right? A misnomer, but the return of government treasuries that they've basically ever been. So it seems like the market is pricing for extremely low risk. When does that change? Like, effectively, how do you reconcile the low risk premium in the markets today to this extremely high sort of tail risk that you're talking about?
I mean, basically, the markets have been managed, if you like, in ways which we don't fully appreciate. Everybody in the investment management system has been educated not in proper economics. an understanding of money and credit. They've been educated in Keynesian economics predominantly. I mean, on the margin, there's some monetarists there, but monetarists are still, they're mathematical economists, which is a non-science. It's not right. It's completely untrue. The other thing they believe is government statistics. Now, you can prove anything with statistics except the truth. And this is a point which people forget. The whole system, if you like, is in thrall to governments and the central banks. But they're wrong. And the thing that's going to trip them up, I mean, we've had this before in this country. 1976, we had a similar situation. We had a far left-wing government, which was busy trying to nationalize this, that, and the other thing. I mean, they really were. They were terrible. I mean, this lot is arguably worse. But anyway, they were terrible. And their budget deficit was soaring. I mean, it really was. And in the year of 75-6, fiscal year 75-6, which runs to April 4th, the government's funding requirement was an extra, I think it was an additional something like 27%. No, it was a bit less than that. I think about 20% of the outstanding gilt market. So in other words, I mean, the funding requirement was just through the roof. Sterling started to collapse on this. I mean, it really did fall very, very heavily. And the problem was that the Bank of England was running out of foreign exchange. So the Chancellor of the day, Dennis Healey, wanted to try and negotiate a $3.5 billion loan from the IMF. And he was just going on a plane to, I think it was on the 28th of September, he was getting on a plane to go to the annual meeting of the IMF in New York. And he was sitting in the VIP lounge in Heathrow with a large gin and tonic when he got the call from the Bank of England, "Get back here, sterling's collapsing." So his trip to New York was cancelled. He went back, and there was the IMF then in November sent some people in to look at the books, and they stayed in Brown's Hotel under pseudonyms. But then some clever reporter managed to find out who they were, so they blew their cover. But basically what happened, I mean, there was a bit of toing and froing, and, the IMF leaning on the politicians and saying, look, you've got to do this, otherwise you're not going to get the money, and to hell with you. So eventually they had to agree to what the IMF wanted them to do, which basically was to cut spending, balance the budget, cut spending, raise tax, balance the budget. That was the important thing. Various left-wing ministers left that stage, and interest rates were running. I think they had gilts were issued in 76, but by sort of Octoberish, the gilts that had been issued in that year had coupons of as high as 13.25%. 13.25%. So that's the thing to bear in mind. There was something called a buyer's strike in the market. I mean, the institutions refused to buy gilts for the very simple reason, risk. What we were talking about earlier, risk in the bonds. And interest rates were driven up to 15%. The yield on the long end of the gilt market peaked at 16.4%. And that was in October. That was October 76. Due to the IMF's insistence that the politicians stop prattling around and actually deal with financial end things, cut spending principally, those bond yields fell to 11.4%, something like that, 11.2% by October 77. So you can see, this sort of thing has happened. It has happened before. We're going to get the same thing again. And I can tell you that looking at the UK's situation, it's at least as bad as it was in 75-6. The only difference is that because the dollar is tanking, sterling looks relatively good. But that's not going to last for very long. And according to the Bank of England, 30% of gilts are actually held by foreign institutions, mainly hedge funds, arbitraging between short-term and out along the yield curve. In other words, they're doing repos, cash repo, to invest along the yield curve. They're going to run. They're going to get the hell out of it. There's got to be some massive
they have
selling.
no long-term interest in the economy, right? They're using it as a financial tool.
Alex, you're right. Not only that, but they're going to start losing huge amounts. So they're going to get the hell out, I can tell you. So leveraged in their own positions. I mean, it's just crazy.
It is an interesting dynamic you point out. In the majority of these debtor nations, it is the people and businesses in those nations who own the majority of those assets. Like 80% of long treasuries are owned by U.S. corporations and citizens, I believe.
Yep.
Right. So it's really those people on the margin who ultimately sort of decide the price, right? Foreign trading partners like China, in your case, hedge funds for the gilt.
Well, you see, this is another aspect, I think, of Trump's tariffs. Basically, he's killing global trade. And so any international conglomerate, Chinese company or whatever, doesn't need to hold on to so many dollars. So you've got automatically selling, if you like, non-government sources around the world. And you haven't got the demand on the other side. And when you look at US exposure to foreign currencies, it's minimal. It really is. I mean, you sort of look at, Chinaman, let's say, or a Brit buying a US share actually has to buy dollars and buy the share. But you guys, in America, I assume that's where you are, you just walk into the market and buy an ADR. The prices, I remember when I was a broker, there was actually good arbitrage opportunities between ADRs and London. And I guess there still are, because in a sense, the two markets operate separately. But, demand for foreign stocks in the US is almost entirely an ADR form. So you don't have the foreign exchange exposure out of dollars. But I tell you what, everybody's got your bloody dollars. I mean, the Treasury tick figures reckon that that foreigners own roughly 40 trillion of financial assets and dollars, including deposits and T-bills and so on and so forth. So and commercial bills. So 40 trillion is a lot more than the GDP. It's somewhat more than the government debt.
Yeah, that's a lot of dollars floating out there, and there's nowhere in the U.S. that there's $40 trillion worth nominally of yuan or gilt or anything else.
Yeah, exactly.
At WorthNet, we think it's really important to always challenge our assumptions to make sure that we are looking at the markets, the economy, and the micro investment decisions that we make in our own portfolios, and really just challenge what our worldview is and how long it's going to hold up. Markets have a tendency to change. Economies have a tendency to shift. Anyone who's lived through 1987, 2000, 2008 has seen this firsthand. And so we like to be on a lookout for where things might go from here. The challenge ultimately in managing investments is making sure you have a plan that enables you to sleep well at night, a plan that is set up to manage macroeconomic risk, market risk, without bolt holing and missing out on all of the opportunity that's out there. If you're looking for a partner to help you manage your investments, just go to worthnet.com. We've built a network of independent boutique investment advisors by invitation only, who we believe are facing down some of the most interesting, unique, and frankly challenging problems in finance today. Just fill out the quick 1-minute questionnaire, share a little bit about your financial situation and what your goals are, and you'll be matched to an advisor whose focus aligns with your goals. An initial consultation is completely free, and who knows, maybe you'll find the partner you're looking for to help you build that portfolio that helps you sleep well at night. I always appreciate about your view, Alasdair, how historically informed it is and how broad it is. You're looking at these measures like, how many financial assets in dollars, the rest of the world owns. So it's fascinating to dig into the data with you. If somebody wants to follow you and sort of follow how you're watching these markets, how can they get a hold of you?
Yeah, through my Substack, which is macleodfinance.com, or you can go to alasdairmacleod.substack.com. But Macleod Finance is probably the easier one to Google. And I'm really in the business of trying to educate people, give them some guidance as to, about economics, about money, the difference between money and credit, which so few people understand. I mean, it's just ridiculous. Not even economists understand it. The biggest arguments I have actually is with economists who just don't understand. They think that the role of a bank basically is intermediation. Oh, yeah, God Almighty. I mean, they're not with it. I've got a huge job to do to educate people, and but My mission is to do that because I know, really, through watching history of events like this and all the rest of it, and also watching this current lot of politicians, motivations, why they're doing it, geopolitical situation as well. I watch all these things to try and give some guidance to people about their own affairs. We're never in the business of making investment recommendations, but, at least hopefully the people who subscribe to my Substack do have a better understanding, if you like, of what's going on and therefore the context of their own decision-making process.
Yeah, I read a piece of yours on August 4th that you wrote about how banks create credit and their role in the system, and you've long sort of talked about that one. So I greatly appreciate all of the education you put out into the world. I appreciate you coming on the show today. Thank you so much for your time.
Thank you for having me, Alex. It's been my pleasure.
As always, if you enjoyed this video, click subscribe or like. Really appreciate it. Thank you very much. Have a good day.